Imagine having $1,000 sitting idle, or needing a hefty $100,000 for a house, but struggling to find someone to lend or borrow from directly. This is where banks step in, weaving a complex web of financial transactions. But have you ever wondered how banks gained the power to create money? In this video, we delve deep into the mechanisms behind banking, from the basics of deposits and loans to the intricate processes of money creation and regulation. So, without any further delay, let's get started. Section 1. The role of banks in financial intermediation. Banks serve as the vital linchpin in the intricate machinery of finance, facilitating the flow of funds between surplus units, depositors, and deficit units, borrowers. At their core, banks act as intermediaries, bridging the gap between those with excess funds seeking a safe haven for their money and those seeking capital to finance various endeavors. From individuals saving for the future to governments managing public funds, depositors entrust their resources to banks for safekeeping and potential growth. On the other side of the equation, borrowers ranging from households seeking mortgages to corporations funding expansions rely on banks to provide the necessary capital. By pooling deposits from multiple sources, banks aggregate funds into sizable pools, which they then allocate to borrowers in the form of loans. This process not only mobilizes idle funds, but also allocates capital to where it is most needed, thereby fueling economic activity and growth. In essence, banks serve as the lubricants of the economy, greasing the wheels of commerce and investment. Section 2. The mechanics of making loans. The essence of banking lies in its ability to transform short-term deposits into long-term loans, a process known as maturity transformation. When a bank receives deposits from customers, it retains only a fraction as reserves, while the remainder becomes available for lending. This disparity between the duration of deposits and loans enables banks to match the varying needs of depositors and borrowers. Once a borrower seeks financing, the bank evaluates the creditworthiness and risk profile before extending a loan. Upon approval, the bank disburses the funds, often with predetermined terms and interest rates. These loans can range from personal mortgages to corporate lines of credit, serving diverse economic needs. Importantly, banks profit from the interest differential, the spread between the interest paid to depositors and the interest earned from borrowers. This spread, coupled with prudent risk management practices, forms the bedrock of banks' profitability. However, this profitability is not without risk. Banks must navigate various factors, including interest rate fluctuations, credit defaults, and economic downturns, to maintain stability and solvency in the face of uncertainties. Section 3. The creation of money. One of the most intriguing aspects of banking is its role in the creation of money. Banks possess the unique ability to generate money through the process of lending. When a bank receives a deposit, it is required to hold only a fraction of that deposit as reserves, typically mandated by central bank regulations. The rest of the deposit is available for lending. This fractional reserve system enables banks to create new money by issuing loans. When a bank extends a loan, it does not merely transfer existing funds from one party to another. Instead, it effectively creates new money in the form of credit. This newly created money enters circulation, allowing borrowers to make purchases, invest, or undertake projects. Moreover, the money creation process exhibits a multiplier effect. As the newly created money circulates through the economy, it can be redeposited in other banks, which can then lend out a portion of those deposits, further amplifying the money supply. This cycle continues, contributing to the expansion of the overall money stock and stimulating economic activity. Section 4. Diversifying revenue streams. Beyond traditional lending activities, banks bolster their financial health by diversifying their revenue streams. While interest differentials from loans and deposits form a significant portion of their income, banks engage in various ancillary services and financial activities to augment their earnings. One avenue for revenue generation is securities trading. Banks participate in financial markets, buying and selling securities such as stocks, bonds, and derivatives. Profits from these transactions contribute to their overall income and can be substantial during periods of market volatility. Additionally, banks offer a plethora of customer services, ranging from checking accounts to investment banking. They earn fees for these services, including account maintenance fees, transaction fees, and advisory fees. Investment banking services, such as underwriting securities and facilitating mergers and acquisitions, can be particularly lucrative. Furthermore, banks delve into the distribution and sale of financial products like insurance and mutual funds. By acting as intermediaries for these products, banks earn commissions and fees, further diversifying their revenue streams. This multifaceted approach to revenue generation helps banks mitigate risks associated with fluctuations in interest rates and economic conditions, ensuring stability and profitability in dynamic financial markets. Section 5. Banks as instruments of monetary policy. Central banks wield monetary policy tools to regulate the money supply and influence economic activity, with commercial banks serving as intermediaries in this process. Through various mechanisms, central banks seek to achieve macroeconomic objectives such as price stability, full employment, and economic growth. One key tool utilized by central banks is the adjustment of reserve requirements. By mandating the proportion of deposits that banks must hold as reserves, central banks can influence the amount of money available for lending. Increasing reserve requirements restricts lending capacity, thereby reducing the money supply, while decreasing requirements stimulates lending and increases the money supply. Central banks also engage in open market operations, buying and selling government securities to control the level of reserves in the banking system. Purchasing securities injects liquidity into the system, while selling them withdraws liquidity. Commercial banks play a crucial role in transmitting these monetary policy actions to the broader economy. By adjusting lending rates and credit availability in response to changes in central bank policy, commercial banks act as conduits through which monetary policy influences consumer spending, investment, and overall economic activity. Section 6. Risks and regulations. Despite their pivotal role in the economy, banks face various risks that can jeopardize their stability and solvency. These risks include credit risk, market risk, and liquidity risk. Credit risk arises from the potential for borrowers to default on loans, while market risk stems from fluctuations in asset prices and interest rates. Liquidity risk emerges when banks are unable to meet short-term obligations due to insufficient cash or assets. To mitigate these risks and maintain financial stability, banks are subject to stringent regulatory frameworks. Regulations aim to safeguard depositors' funds, promote market integrity, and prevent systemic crises. Key regulatory measures include capital adequacy requirements, which ensure banks maintain sufficient capital buffers to absorb losses, and liquidity regulations, which mandate the maintenance of liquid assets to meet short-term obligations. Additionally, regulatory authorities conduct regular supervision and oversight to monitor banks' compliance with regulations and assess their risk management practices. In the event of financial distress, regulators have the authority to intervene and implement corrective measures to mitigate systemic risks and protect stakeholders. In the intricate tapestry of finance, banks serve as pivotal players, wielding significant influence over economic dynamics. Understanding their evolution, from humble intermediaries to creators of money, sheds light on the complexities of modern banking. As we navigate through the intricacies of financial systems, it becomes apparent that the power vested in banks carries profound implications for global economies and societies alike. Thanks for watching. If you found this video insightful, don't forget to like, share, and subscribe for more thought-provoking content. Until next time, stay curious.